Okay, let's dive right into this explainer and demystify the fascinating and honestly sometimes pretty controversial mechanics of how governments figure out exactly what your property is worth, so they can tax it. At first glance, it sounds like a straightforward math problem, right? But as we're going to see, valuing real estate for tax purposes is actually a massive global puzzle. And different countries, well, they solve it in vastly different ways. Because whether you own a little family home, run a giant manufacturing factory, or manage an international airport, someone, somewhere, has to figure out what it's worth to tax it. So here's our agenda to figure out how they do it. 1. The value of property. 2. Taxing land and improvements. 3. Taxing only the improvements. 4. The valuation solution. And 5. Calculating replacement cost. Section 1. The value of property. Understanding the basics. So, to really grasp property rates, we have to look at the two distinct ways assessors actually look at real estate. First up, we have annual value, or AV. This one's all about income potential. Think of it like the rent a landlord would collect over an entire year, assuming they're the ones handling things like insurance and maintenance. Then, on the flip side, we have capital value, or CV. This is exactly what you'd pay to buy the property outright today, on the open market as a single asset. These two concepts basically form the absolute bedrock of property rating valuation. Jurisdictions just choose between them based on their specific laws and the types of property they're dealing with. Section 2. Taxing land and improvements, the comprehensive approach. Now let's see how those basics build into the most comprehensive taxation strategy available. This method targets both the dirt itself, the land, and the improvements, which is just a formal way of saying the buildings constructed on it. By taking the property as a whole, assessors capture the complete value of the heritament. That's a very fancy legal term for the total inheritable property. It leaves absolutely nothing out of the equation. And there's a good reason this method is often considered the gold standard. By taxing both the land and the buildings together, you generate a massive rateable value. Now, why does that matter to us? Because a larger tax base allows the government to place smaller tax rates on individual taxpayers. Spread the burden, right? Plus, doing these comprehensive valuations generates incredibly rich data that's super useful for other things, like approving mortgages or facilitating compulsory government acquisitions. It's also simple to explain to the public, and honestly pretty easy to assess if you have good market data. But there is a catch, a pretty big one. This ideal system instantly breaks down under certain conditions. For this to work at all, you absolutely must have an active and efficient land market to give you reliable, comparable evidence. On top of that, you need a highly efficient land information system, or an LIS, to identify exact property boundaries and track who actually owns what. If a city or country lacks those two critical elements, the whole system just grinds to a complete halt. Which brings us to Section 3, taxing only the improvements, the Ghana system. So what do you do when you don't have that perfect land data, but the government still needs to collect necessary revenue? Well, you pivot to an improvements-only rate. Let's look at Ghana, for example. Under Section 146 of 9 of their Local Governance Act of 2016, that's Act 936, the law strictly taxes structural developments. We're talking about buildings, walls, and permanent physical alterations to the land. It completely ignores the dirt they sit on. And it also ignores unattached chattels, meaning things like movable furniture or temporary sheds. Only the permanent physical structures get taxed. Now, as you might guess, this workaround comes with some heavy baggage. Taxing only improvements can be highly regressive, meaning the assessments aren't necessarily based on a person's actual ability to pay. But even worse, it famously acts as a disincentive to development. Just think about it. If you own completely undeveloped land, you attract zero tax. But the exact moment you decide to build and improve your community, boom, you get handed a tax bill. Not to mention, it requires incredibly subjective assessments and can be very cumbersome and expensive to administer. Section 4. The valuation solution, the contractor's test. This brings us to a massive mechanical challenge. If you are only taxing the buildings, how do you actually calculate the value of these standalone improvements without an active standard market? Seriously, take a second and ask yourself, how do you value specialized properties that are rarely, if ever, sold? Because this is the ultimate headache for any tax assessor. I mean, the comparative method works great for houses. You just look at what the house next door sold for. But you can't exactly pull up a real estate app to see what a medium security prison, a massive oil refinery, or an international airport recently sold for, right? Direct market comparison is literally impossible for these highly specialized properties in manufacturing, public administration, and infrastructure. So, to solve this seemingly impossible puzzle, assessors use something called the depreciated replacement cost method, or DRC. It's often called the contractor's test. This is the exact method applied in Ghana under Act 936 for valuing improvements, and it acts as the valuation method of last resort. Instead of looking at what a property would sell for, it asks a completely different question. What would it cost to rebuild it today? Section 5. Calculating replacement cost step by step. Let's break down exactly how this brilliant workaround functions in the real world. By following these 4 steps, the core assumption is that the value of the existing property equals the cost of building a modern equivalent today, minus whatever wear and tear it suffered over the years. So, step 1. You estimate the gross replacement cost of the improvements at current prices. Step 2. You deduct an allowance for physical depreciation, like age and wear, as well as functional obsolescence. Step 3. In a standard DRC model, you'd add the open market value of the land back in. But hey, remember our Ghana example? Because they run an improvements-only system, they actually skip step 3 entirely and ignore the land. Which brings us right to step 4, your final depreciated replacement cost. Now, that second step, depreciation, that is the tricky part. And it generally happens in one of 3 ways. The simplest is the straight line method, where a fixed percentage is just deducted evenly over the building's expected life. Then there's the reducing balance method. That calculates depreciation on the remaining value each year, which gives you much higher deductions early on in the building's life. Finally, there's the sinking fund method. This one's highly complex and basically acts like a hypothetical savings account, earning interest until it supposedly has enough to replace the building at the end of its life. So let's quickly recap our journey. On one hand, we have the ideal land and improvements model. It's comprehensive, sure, but it is totally reliant on great land data and active markets. On the other hand, we have the improvements-only models. And notice how method 2, the depreciated replacement cost method we just walked through, completely bypasses the need for market data. That makes it a highly pragmatic, essential solution for places like Ghana, even if it does come with the limitation of being pretty subjective and, acting as a potential disincentive to actually developing the land. Since the choice of a tax base has such massive policy implications, it really leaves us with one critical question. Because taxation isn't just about collecting money, is it? It actively shapes the future of our built environments. So, if our current fallback systems accidentally punish the very people who want to build and improve our communities, how do we innovate this system for tomorrow? Definitely something to think about. Thank you so much for joining me on this deep dive into the fascinating world of property rates.